Hello everyone and welcome back to the Toronto Real Estate Podcast. I'm Ed Layton and I'm joined by my wife.
Hello, this is Cheryl Layton here.
And we form Layton Homes and we're registered as part of Keller Williams portfolio in Toronto. We are once again joined by our friend Jason Friesen, who's the managing partner at Outline Financial, to discuss some of the big picture stuff that's been happening in the last couple of weeks. That affect all Canadians pretty much, and it certainly affects the housing market.
Thanks
welcome,
for having me.
Yeah, welcome back, my
Excited
friend.
to be back.
It's so nice to have you, an expert insight, especially at this time.
Lots of stuff to talk about.
Definitely.
Lots of changes, I think, from the last time we chatted. Lots and lots.
Yeah. So, I mean, I kind of alluded to it in the ramp up there, but we've had a federal budget that's in the last week or so.
Yeah.
And yesterday, the Bank of Canada announced obviously some changes as well. I mean, I don't know if it's just me, but I'm extra aware of where we sit right now, sort of economically and from a monetary policy standpoint. I mean, I can't help but feel a tiny bit disillusioned because, I mean, the Bank of Canada, most of the communication was, inflation was a transitory thing and the toggling on fiscal policy and interest rates were going to mean that we were completely in control, and then they came out, I don't know, about a month or so ago, maybe a bit longer than that, and said, actually, mea culpa, my bad. The truth is that this inflationary thing isn't a supply issue, and it's a bit more permanent than we originally thought. So it has me a little bit shaky. I mean, how are you feeling about the economy at large?
The economy does seem to be chugging along. Now, to your point about the Bank of Canada reversing course on what they thought with inflation, I have to say that the big five banks have been saying this was a bigger issue, and it's about time that the Bank of Canada actually caught up with what most economists in Canada were saying all along.
Right.
It does look like we are in for a much more aggressive approach on rate hikes coming up on the overnight lending rate side than I think even we thought a couple of months ago. So it'll be interesting to see how that plays out. Just simply the fact that the amount of debt floating out there and amount of people that are leveraged on debt, will fewer rate hikes have a greater impact? I guess that's
the big question.
Exactly. That remains to be seen. Obviously, seeing a 50 basis point rate hike, it's the first time it's happened since 2001, I think.
Yeah.
And talk of a back-to-back 50 basis point rate hikes, another one coming June 1st when the bank meets again. It's definitely has shook a few people, and obviously has an impact on carrying costs for borrowers as a whole.
Yeah, and I feel that we've been through such an interesting period with COVID and all the worries, the economic worries around that. And Ms. Freeland was, exercising some sort of restraint and caution and making all the right sort of noises around debt ratios, it's being tied to GDP. But the question is that a real assertion to make? We've got all sorts of macroeconomic things going on in the Ukraine, and then the impact of energy and all that kind of stuff. It all feels a bit like, I don't know, hot air.
I think also their goal to bring the debt to GDP ratios down also coincide getting down to the levels. 4 years from now, they expect them to be pre-pandemic levels, which also happens to fall when there's an election. So I think they probably could have been a bit more aggressive. I don't know if anyone read the 300 pages that were released. But I think
that was directed at me. No, very few.
But I think this started the years of Harper and Martin trying to keep a balanced budget, and then when Trudeau came in, it was let's run a deficit to focus on some major infrastructure changes. Our infrastructure programs for a couple of years, and then the pandemic happened. So it does look like they're starting to try to rein it in, but not fully as much as they should be doing.
Yeah.
It starts to make you worry for the long-term future, running that large of a deficit for that long. Yeah,
for sure. I mean, I think that's kind of the worry that everybody has around this stuff.
Now, the federal budget announced some help in the form of tax-free saving mechanisms.
Yes.
Do you think they're actually enough to help Canadians afford their first home?
So I feel like it helps the upper middle class because it's not necessarily something that's going to help bring house prices down. Mm-hmm. It's just an alternative form of a savings to help with your house purchase. So basically, what it allows is the setup of a $40,000 tax-free account that you can use towards your first home purchase. Mm-hmm. You still have to have $40,000 to put into that. That's the consideration. But instead of working like an RSP where it needs to be paid back, it works more like a TFSA where you can pull it out tax-free and there's no repayment on it. So if you're looking at it from the perspective, it's a good incentive. $40,000 a person or $80,000 for a couple plus another $70,000 for a couple of RSP. You have the ability to potentially access up to $150,000 for buying a house when the time comes from your RSP and your first time.
That makes sense.
Yeah, I don't think it's
Now, as the federal budget has put some of these first-time buyer mechanisms and incentive programs in place, how has that then affected your business running up to yesterday's rate hike?
It was big on ideas, but nothing was really put into play. I mean, everything is a talking point that will eventually, be implemented at some point. I think that comes in 2023. So it hasn't had any short-term implications. In fact, I haven't really fielded many questions about that program. So we'll see what it looks like when the details are rolled out. The other program that was rolled out was that home buyer incentive program where there's basically like a shared equity approach where the government helps in giving you a portion of the down payment to go towards the purchase.
Yeah.
That program was in place, but to be honest with you, we've never, I don't know a single bank that has been on board with that. And it was also, we are mainly in the Toronto market and it had a lot of limitations as far as the maximum purchase price that you could look at. So until that program's revamped to help in the GTA, I don't see it gaining much traction. The other consideration is if you have 10% to put down, excuse me, if you have 10% to put down, getting another 5% from the government's great, it helps a little bit. But the problem with that is that 5% you're borrowing from the government isn't paid back just the amount they've given you, but at whatever your house is appreciated by. So if 10 years from now your house is doubled in value, you're paying double the amount that you borrowed from them. So are you not maybe better off just with slightly higher carrying costs and then being able to carry the entire, or take advantage of the full kind of increase? Exactly. So that's my thoughts on that. I had very few clients that even inquired about that program. It wasn't something that, it sounded great, I think in theory, but when you look at the kind of the mechanics of it and how it works.
How it actually would impact you,
exactly.
both in terms of buying and selling, ultimately 10 years down the road.
Exactly.
So, I mean, I don't know if there's a specific answer to this, and I know that from previous conversation with you, each client that you have is unique, and your consideration set is different based on their risk tolerance and stuff like that. But given that we could be moving into some unpredictable times, is your position on variable versus fixed changed?
That's a good question, and again, it is an individual, decision to make. It's not a one-size-fits-all approach. Always the higher you go towards the top end of your budget, the less wiggle room you have. So the more inclined I'd be to suggest that maybe you look at a fixed rate. But there always are a ton of factors in play. Is there a possibility you may sell within the 5-year period? We know that fixed rates come with much higher penalties. What are your plans? Are you planning on potentially wanting to refinance, doing anything over that 5-year period? The variable rate will give you much more flexibility.
Yeah.
We're just right now coming to the end of, we had a lot of clients booked with fixed rates that were below 3%. Now to put that into perspective, fixed rates are butting up against, or in some cases above 4% now.
Right.
And with the Bank of Canada revised forecast that we could see, 2%, 2.5% in interest rate hikes. Those fixed rates that were below 3% are looking pretty attractive to clients. But when you're looking at, a variable rate that today is, prime is at 3.2, in some cases people are able to get 1% below that, so they're still paying 2.2% and fixed rates are at 4. There's a heck of a lot of runway between the variable and fixed. We have a lot of clients that are still, going variable. Absolutely,
Yeah.
absolutely.
Yeah, it's interesting.
Because, what does that look like then if you have a $450,000 mortgage, how much more is that now that we're looking at paying additionally over the month?
Sure.
I think I've read in places
think it's
that it's
about
about
$100,
$100, right?
So let's just look at a couple scenarios that I'll pull up right now. So let's just use a $500,000 mortgage, okay? So a variable rate for a $500,000 mortgage, as of today at 2.2%, is going to cost a borrower $21.65.
Right.
A 4% mortgage is going to cost a borrower $26.30. So you're looking at a pretty substantial amount, $470 difference. That's a lot of money for a person. Yeah, exactly.
Yeah.
So, when I'm going through calculations with a client and discussing variable versus fixed, I'm not talking to them about that 2.2% payment. I'm talking to them about, do you have the ability to stomach a payment if it hits 3.2, 4.2, 5.2? And I think if the answer is no to, being more comfortable with those higher payments, then the fixed rate probably makes sense. It helps, at least with some budgeting and forecasting for a 5 period.
Let's say that you've got a bunch of people that have borrowed, they're highly leveraged at low rates. I'm going to ask the boogie question. Half a percent substantial is a move. Most people are thinking 0.25% on regular intervals, and the advice was always early, small, and frequent in terms of raising it. So is this too much?
The Bank of Canada has to do something. I think they sat on the sidelines in January, and I think had they done it earlier, we wouldn't be seeing 0.5% increases. But now I feel like their backs are against the wall. Inflation is clearly running rampant. They have to do something. So had we maybe started this a little earlier, again, the big banks were calling for rate hikes earlier than March, and so had we maybe saw a rate hike in January and another one in March, maybe we'd only be seeing a 0.25 point here. But we are where we are today.
That's true. Well, let's hope that it's a tolerable increase, even though it's a big one. The backstop on all of this always was the stress test. So unless I've missed something, it's still at 5.25%.
Believe it or not, it's easier to qualify today for a variable rate than a fixed rate. And the reason for that is the stress test rate is indeed at 5.25%, but the stress test is the greater of 5.25% or 2% above the face rate you're paying.
Right.
So if you're taking a fixed rate at 4%, you're qualifying at 6%, which is about a 10% reduction in your qualifying power. So, traditionally variable rates are more of a risky, proposition for a client because they can fluctuate, but they're actually easier for a borrower to qualify with today versus taking a fixed rate.
Which is ironically or perversely
exactly
counterintuitive.
Exactly.
Okay.
Now, I obviously saw your phone was ringing like crazy earlier. So, how much impact has this had on your day-to-day in the last couple of weeks, and then especially yesterday's announcement?
So I think things are still very healthy and we are busy. I'm not seeing that same level of frothiness that I did in the spring of last year, and then even starting this year, January, February. I'm seeing more questions and buyers that want to readjust their expectations and their budgets. And then, I think that coupled with the fact that, I'm seeing compressed timelines. Everyone wants to do everything faster. And so it's put more pressure on the process. I think people are nervous and if someone's bought and hasn't sold, they're trying to figure out how fast they can get their house sold. there's lots of questions that are coming up that make me think that the general kind of, my clients as a whole are a bit more nervous than they were, in 2020 and 2021.
Right. Now, we do pay a lot of attention and have clients in the luxury real estate market, and there has definitely been quite a lot of movement between the $3 million to $10 million mark in the last few months, especially. Why do you think that is?
That's a good question. I think I really think that people that haven't been impacted. Right. That's the reality of it, right? There's opportunity in any market. I think that's really the reality of it, and it just really, rates are still relatively low from a historical perspective, and those buyers could be taking advantage of low rates on their pre-approvals that are still in the twos, right? So that could be a reason.
I mean, I was wondering, and I kind of go back to something that you brought up in our last podcast.
Right.
I think you said there was projected, I don't know if you still stand by this or whether it's changed, but there was $1 trillion of family wealth, generational wealth being passed between generations. Projected, $1 trillion projected between now and the end of 2026.
Yeah, from 2016 to 2026, $1 trillion was being passed down from the boomer generation.
Do you think that impacts things?
100%,
yes.
Absolutely. I'm seeing less people take that initial, there's always like kind of that ladder, that home buying ladder that you start on the bottom rung, you buy it like a condo or a starter home. I'm seeing more people jump to that, that maybe not a forever home, but not a starter home.
Yeah, it's a freehold,
exactly, or detached, exactly. And I'm seeing on a regular basis, gifts of $300,000, $400,000, $500,000, if not more. And the other, not alarming, the other interesting part about that is that people, for the most part, are not borrowing. So parents are not borrowing to pass that money down. It's coming from their own wealth, exactly, which is an interesting, thought there. So
from an underwriting perspective, surely that affects. I mean, I've not been an expert in underwriting. I mean, the family wealth, can that be layered into an individual's application to borrow?
I'm seeing more times where parents are co-signing as well. So giving a gift, the parents are, washing their hands of the transaction other than helping, give money towards the down payment. But I've been seeing more times where parents are now co-signing. So parents will go on, whether they take a 1% ownership in the property or whatever. That to me is a bit concerning, unless there are, certain circumstances where maybe someone is self-employed and doesn't show a lot of income, or there's a reason for that. But the mortgage qualifying guidelines are the mortgage qualifying guidelines for a reason. I always suggest to clients, there's a reason why you qualify for this amount, right? So if you qualify for $1 million, are you going to be comfortable taking a mortgage of 1.2 or 1.3? So adding a cosigner will help you hit that number. That's great, you qualify for it. But how does that impact your cash flow, on a month-to-month basis? Exactly.
Sure.
And I find the one biggest expense that most young families have that doesn't get factored anywhere into the calculations, childcare costs.
Oh God, yeah.
In a childcare, it's funny
exactly.
Yeah. You think about it, like a $5,000 credit card, is factored into your qualifying, and
the childcare isn't.
Exactly, but a $2,500 a month childcare cost isn't, and that's the equivalent of, like a $700,000 or $800,000 mortgage that you're paying on top of your mortgage, right?
I don't want to get into the ethics and the human rights conversation, but it's not crazy because it's so substantial.
It is absolutely.
So we have a few clients that are looking to sell in the fall, and we're trying to sort of figure out what our counsel would be to them now, because things might change in the second part of this year. Do you foresee 1 or 2 rate increases between now and the end of the year?
I think there's a high probability we could see rates 1% higher than they are today by the end of the year. We could see a 50 basis point hike plus another, couple more 25 basis point rate hikes by the end of the year. But I think the big consideration, for clients that are considering selling, we are seeing more listings hit the market, and it still is definitely far from being a balanced market, but it's shifting more that way. So if you're a seller expecting absolute top dollar from your property, I think it's probably no better time than now. There's too much uncertainty in the future, based on everything that we're seeing, for it to be, again, I think, if your plan is to get the absolute top dollar, which, I mean, every seller has that intent, or, for the most part at least, now I think offers you a bit more certainty than waiting for 3 or 4 months.
And at the end of the day, one has to buy and sell in the same market.
Exactly.
So when that happens, it washes all of the macro considerations and just becomes about the good old-fashioned realtoring of things.
Yes.
All right, I think that's a great wrap up. I mean, we're 21 minutes now.
Excellent. That's a bit
I
of
know, it
first.
went by
super fast.
Yeah. So thank you very much for your time
Thank you,
today,
Jason.
Jason.
Thanks again.
We obviously love chatting to you, and you. I think you bring some incredible value to the people that are listening to our podcast.
Definitely.
Thanks again for having me.
Yeah.
Can I plug outline.ca as my website? Check it out.
100%.
And I think at the end of the day, for us, when we're advising clients on I said this earlier, off the microphone. As mortgage brokers, we're not here to give advice on real estate. We're here to give advice on finances. And to me, the one biggest point that I can make here is affordability is the most important decision right now at this point in time. Regardless of what happens in the short term or the medium term, I still believe long term in real estate, and I think it's safe to say that 5 years from now, 10 years from now, your house will be worth more than it is today. But the affordability will get you through any market. As long as you're buying a place that is comfortable and fits in your budget, you're not overextending yourself. I still think that real estate is a good play. But more so now, really drilling down on your budget and making sure that this is something that's very comfortable to you is really the best decision that you can make.
And with that,
Thank you very much. Please do subscribe to Spotify and follow us, the Toronto Real Estate Podcast.
we'll also be putting the video on YouTube. We'll start to build up that channel as well. So if you don't want to be on Spotify, you can see us on the first Toronto Real Estate Podcast on YouTube. So everyone wave at camera. Perfect.
Awesome.
Thank you. That was great.
Thank you. Next time we'll do it at the new office.
Yeah.
Definitely.
So because I actually think, especially with everything that's going on, I think doing it every few months, or every quarter, going into the next quarter,
It's super helpful stuff.
is helpful.
There's uncertainty right now, so if you can give people any kind of comfort and just help talk them off a ledge.
Yeah.
Yeah.
Sure. Because
Because there's doom and gloom out there as well, right? I think that's the reality of it. The people that look at the better dwellings, oh geez, that's the